Between December the 20th and December 24th, 2025, something unprecedented happened in New York. 47.6 million ounces of silver vanished from registered vaults in just 4 days. The paper price? $71 per ounce. The price to actually hold it in your hands? $85, sometimes $95. Major dealers across America began posting 8-week delivery delays. While Wall Street's official price tickers showed nothing unusual, 60% of deliverable inventory gone. Yet the market pretended everything was fine. This isn't a glitch in the system. This is the system quietly breaking apart. And the people who understand what's really happening are racing to get physical metal before the door closes completely. What you're about to discover in the next few minutes may fundamentally change how you view commodity markets forever. Welcome to Currency Analyzer, where we decode the market signals that others choose to ignore. Now, if you've been following financial markets long enough to remember when a handshake still meant something, I'd appreciate it if you'd subscribe to this channel. We're building a community of serious thinkers here, not speculators chasing the next meme stock. And please, drop a comment below telling us where you're watching from today. Are you in Texas, London, Singapore, Mumbai? We want to know, because what's happening in silver markets right now doesn't respect borders. Let's begin. On December 24th, 2025, a seasoned commodities trader in Manhattan sat staring at his screen, confused. The COMEX silver price showed $71 per ounce. But when he called 3 different bullion dealers to actually buy physical silver, the quotes came back at $82, $85, and $89. One dealer told him the wait time was 6 weeks. Another said they were completely sold out. This wasn't supposed to happen in modern commodity markets. And yet, it was happening. The trader had seen price premiums before, small ones, maybe $2 or $3 over spot price. That was normal. That covered dealer costs and shipping. But a $14 to $18 premium? That was something else entirely. That was evidence of a broken market. Between December 20th and December 24th, something extraordinary occurred in the silver markets that most people never noticed. Traders and institutional buyers demanded physical delivery of 47.6 million ounces of silver from COMEX warehouses in New York. To understand why this matters, one needs to understand how commodity exchanges actually work. For decades, the COMEX silver market operated on a simple assumption. Most traders didn't want the physical metal. They were speculating on price movements, happy to settle their contracts in cash when the contract expired. Historically, only about 2% to 3% of contract holders ever demanded actual delivery of silver bars. The exchange built its entire system around this behavior pattern. Think of it like a bank. Most depositors never withdraw all their cash at once. Banks keep only a fraction of deposits on hand because they know that under normal conditions, only a small percentage of customers will need cash on any given day. The COMEX silver market worked the same way. But what happens when that assumption breaks down? What happens when 10%, 20%, or even 30% of contract holders suddenly say, we don't want cash, we want the actual metal? In those 4 days in late December, that's exactly what happened. COMEX's registered vaults, the category of silver available for immediate delivery, held approximately 79 million ounces at the start of December 20th. By December 24th, that number had dropped to just 31.4 million ounces, 60% of deliverable inventory drained in 4 days. Yet the official price barely moved. On paper, everything looked calm. The price charts showed normal volatility. Financial news outlets barely mentioned it. Most retail investors had no idea anything unusual was happening. But behind the scenes, something fundamental was breaking. Major institutional players, the kind who manage billions of dollars, were quietly demanding physical delivery. Mining companies were taking delivery of their hedged positions. Sovereign wealth funds from Asia and the Middle East were converting paper contracts into metal bars. They understood something that the general public didn't. The difference between owning a promise and owning the actual asset was becoming critically important. In financial markets, there's a concept called arbitrage. When the same asset trades at different prices in different places, traders step in to buy where it's cheap and sell where it's expensive. This activity normally keeps prices aligned. But arbitrage only works when you can actually move the asset between markets quickly. Silver's price gap revealed something disturbing. The paper market and the physical market were decoupling. The mechanism that kept them connected, the delivery process, was straining under unprecedented demand. Bullion dealers across America started reporting the same pattern. Customers were willing to pay significant premiums above the official COMEX spot price, and they were willing to wait weeks for delivery. In Texas, a major dealer posted an $11 premium over spot with an 8-week delivery window. In Pennsylvania, another dealer was quoting $14 over spot, for immediate delivery of smaller quantities. In California, some dealers simply stopped taking new orders entirely, waiting to see how the situation would develop. This wasn't panic buying from retail investors. This was calculated positioning by informed players who understood that something in the silver market's structure was fundamentally changing. The COMEX exchange operates on leverage. For every physical ounce in registered vaults, there are hundreds of paper ounces traded through futures contracts and derivatives. This leverage works perfectly until it doesn't. And in late December 2025, the evidence suggested that the leverage mechanism was being tested in ways it hadn't been tested in decades. The question facing serious market participants became simple but urgent. If 60% of silver vaults could drain in just 4 days, what happens when the remaining 40% gets claimed? The answer to that question would have profound implications far beyond the silver market itself. In a solar panel manufacturing facility outside Shanghai, a procurement manager received an email that made his stomach drop. His primary silver supplier, a company he'd worked with for 7 years, was invoking the force majeure clause in their contract. Deliveries, scheduled for January 2026, would be delayed indefinitely. No explanation, no alternative timeline, just delayed. He immediately called his counterpart at a competing solar manufacturer in Germany. "Are you seeing this too?" he asked. The German manager's response was blunt. "We're seeing it. Everyone's seeing it. The silver isn't there anymore." This conversation, repeated in various forms across multiple industries in early January 2026, revealed something the financial markets hadn't fully grasped yet. The silver shortage wasn't just a financial market phenomenon, it was becoming an industrial crisis. Silver occupies a unique position in the modern economy. It's simultaneously a monetary metal with thousands of years of history, and an irreplaceable industrial commodity with no viable substitutes in many applications. And that duality was about to create serious problems. In 2025, global industrial demand for silver reached approximately 580 million ounces. The silver went into solar panels, electric vehicle components, 5G infrastructure, medical devices, semiconductor manufacturing, and defense electronics. Meanwhile, total global mine production in 2025 came to roughly 830 million ounces. On the surface, supply exceeded demand by 250 million ounces. So where was the problem? The problem lay in understanding how silver actually gets mined. Unlike gold, where miners specifically seek gold deposits, approximately 70% of silver comes as a byproduct of mining other metals. Lead mines produce silver. Zinc mines produce silver. Copper mines produce silver. This means silver supply doesn't respond quickly to price signals. A mining company isn't going to open a new lead zinc mine just because silver prices increased. The economics have to work for the primary metal first. And in 2025, several major producing regions faced significant disruptions. Peru, the world's second largest silver producer, experienced prolonged labor strikes at 3 major mining complexes. Production dropped 18% year over year. Mexico, the largest producer, saw output decline as older mines depleted and permitting delays prevented new projects from coming online. China, both a major producer and consumer, quietly reduced exports while increasing domestic consumption for its renewable energy build-out. The 830 million ounces of mine production, that number was actually declining, not growing. Meanwhile, industrial demand was accelerating. The solar industry alone consumed approximately 140 million ounces in 2025, up from 110 million in 2024. Every solar panel requires silver paste for photovoltaic cells. Engineers had tried for years to find alternatives. None matched silver's conductivity and reliability. Electric vehicles used roughly 25 to 50 grams of silver per vehicle. For electrical contacts, circuit boards, and battery management systems, with global EV production approaching 15 million units annually, that translated to another 15 million ounces of demand. 5G infrastructure rollout consumed another 30 million ounces, and that number was projected to grow as telecommunications companies expanded networks. But here's where the mathematics became concerning. If industrial demand was 580 million ounces, and mine production was 830 million ounces, that left 250 million ounces for investment demand, jewelry, silverware, and most importantly, replenishing inventories. Except investment demand in 2025 wasn't selling silver, it was buying silver. Silver ETFs saw net inflows of 85 million ounces. Coin and bar demand from retail investors added another 200 million ounces. Suddenly, the equation looked very different. 830 million ounces mined, minus 580 million for industry, minus 85 million into ETFs, minus 200 million into coins and bars. That left a deficit of 35 million ounces. And this deficit had to be filled from somewhere. Historically, 3 sources filled silver deficits: government stockpile liquidation, recycling of old silver products, and most importantly, investor selling when prices rose. But in 2025 and into early 2026, something changed. The U.S. National Defense Stockpile, which once held over 140 million ounces of silver, had been completely liquidated by 2022. There was nothing left to sell. Recycling, while significant, couldn't scale up quickly enough. Old jewelry and silverware took time to collect and process. And investor selling, it wasn't happening. In fact, the opposite was occurring. China's government and state-linked entities had been quietly accumulating silver since 2022. Import data showed China brought in record quantities, while export volumes dropped to decade lows. India's silver imports in the second half of 2025 surged to levels not seen since 2015. Both nations, with populations exceeding 1 billion each, were moving from being net sellers to net buyers. For business leaders and strategic planners, the implications were becoming clear. Silver wasn't just another commodity experiencing a temporary supply crunch. The structural deficit was real, persistent, and potentially worsening. Companies that relied on silver for manufacturing were facing a strategic decision: secure supply now at elevated prices, or risk production shutdowns later when no silver was available at any price. That procurement manager in Shanghai, after his call with Germany, he spent the next 48 hours calling every silver supplier in Asia. He ended up paying a 22% premium over the official spot price and guaranteeing payment upfront just to secure 3 months of inventory. His CFO questioned the decision. Why pay such a premium when the official price is only $71? His response was simple. Because at $71, the silver doesn't actually exist. A risk manager at a mid-sized regional bank in Charlotte, North Carolina, opened an internal audit report on a Tuesday morning in early January 2026. The report detailed the bank's exposure to precious metals derivatives. One line caught his attention immediately. The bank held short positions in silver futures contracts, representing 8.2 million ounces. In their vault, they had 47,000 ounces of physical silver. He read the numbers again, thinking he'd misunderstood. 8.2 million ounces sold on paper, 47,000 ounces actually held. That was a ratio of 174 to 1. He picked up the phone and called the head of commodities trading. "Tell me this ratio is wrong," he said. The trader's response was calm, almost dismissive. "That's standard practice. Nobody actually takes delivery. This is how the market works. It's always worked this way." The risk manager hung up, unconvinced. He'd spent 15 years in banking, long enough to remember 2008, long enough to know that it has always worked this way. Was often the last thing people said before a system collapsed. The silver market, like most commodity markets, operated on a foundation of leverage that most people never saw. For every physical ounce of silver sitting in a registered vault, there were estimated to be between 250 and 500 paper ounces traded through futures contracts, options, ETFs, structured products, and over-the-counter derivatives. This wasn't a secret. It wasn't a conspiracy. It was simply how modern commodity markets functioned, and the system worked beautifully, as long as one critical assumption held true. That assumption? That most traders would settle in cash, not demand physical delivery. Throughout the 1990s and 2000s, that assumption proved valid. Delivery rates stayed consistently low. The leverage multiplied. Markets remained liquid. Everyone profited. But leverage is a mathematical amplifier. It magnifies gains during calm periods and magnifies losses during stress. And in late December 2025, the stress was beginning to show. The COMEX silver futures market had open interest of approximately 190,000 contracts in mid-December. Each contract represented 5,000 ounces. That meant 950 million ounces of silver were theoretically committed for delivery through active futures contracts alone. The registered vaults, the actual physical inventory available for delivery, held 79 million ounces at the start of that fateful 4-day period. The math was simple and brutal. If just 8.3% of contract holders demanded delivery, the vaults would be completely empty. Historically, that 8.3% threshold seemed impossibly high. Delivery rates rarely exceeded 3%. But in those 4 days, the delivery rate spiked to nearly 6%, and it showed no signs of declining. Major institutional players were driving this shift. A pension fund in Norway converted 500 contracts, 2.5 million ounces, from paper to physical in a single transaction. A mining company in Canada took delivery of 1.8 million ounces to settle hedge positions. A sovereign wealth fund based in Abu Dhabi demanded 3.2 million ounces, paid in full, with instructions to ship the metal to a private vault in Switzerland. These weren't retail investors panicking. These were sophisticated institutions with research teams, legal departments, and decades of market experience. They were making calculated decisions based on risk assessment. And their assessment was clear. Counterparty risk in the paper silver market had become unacceptably high. Counterparty risk, the risk that the other side of a trade can't fulfill their obligation, was supposed to be minimal in exchange-traded markets. The exchange itself guaranteed performance. But what happened if the exchange couldn't fulfill its guarantees? History provided uncomfortable precedents. In March 2022, the London Metal Exchange faced a similar crisis in nickel. Prices spiked violently. Some participants couldn't meet margin calls. The exchange made an unprecedented decision. It canceled billions of dollars worth of trades and suspended the market. Traders who thought they had profitable positions suddenly had nothing. The exchange simply rewrote the rules mid-crisis. In 2024, the cocoa futures market experienced severe delivery failures. Physical cocoa wasn't available to fulfill contracts. The exchange allowed cash settlement at prices that had little relationship to the actual physical market. Again, the rules changed when stress peaked. These precedents weighed heavily on institutional decision makers in late 2025. COMEX had legal authority, buried in contract specifications that few people read, to force cash settlement in the event of extraordinary circumstances. What constituted extraordinary circumstances? The exchange's clearinghouse, essentially, decided that. So institutional players faced a choice. Hold paper contracts and hope the system remained stable, or demand physical delivery while the vault still had inventory. More and more, they were choosing physical delivery. The risk manager in Charlotte spent the rest of that Tuesday reviewing the bank's hedging programs. He discovered that the bank's silver exposure was just one piece of a larger problem. The bank had sold interest rate derivatives to mining companies. Derivatives whose value was partially tied to silver prices. They'd issued structured notes to wealth management clients, notes that promised returns linked to precious metals performance. They'd provided credit lines to bullion dealers, credit lines secured by inventory that might not actually exist. Every piece connected to every other piece. And if silver prices diverged significantly between paper and physical markets, if delivery failures occurred, if the exchange changed settlement rules, the bank's exposure wasn't 8.2 million ounces. It was potentially much larger. He ran stress test scenarios. In a worst-case situation where paper and physical prices diverged by 30%, and the bank was forced to deliver physical metal it didn't have, the potential loss exceeded 180 million for a regional bank. That was catastrophic. He immediately requested an emergency meeting with senior management. His recommendation was direct. Exit all short silver positions. Buy physical metal to cover remaining exposure. Do it now, regardless of cost. The chief financial officer resisted. The premiums are ridiculous right now. We'd be buying at $85 when the market price is $71. That's throwing away money. The risk manager's response was quiet but firm. We're not buying silver. We're buying insurance. And insurance is only expensive until you need it. In a private wealth management office in Geneva, a family office advisor sat across from a client whose family had preserved wealth across 4 generations. The client, a retired industrialist in his 70s, had survived currency crises in 3 different countries during his lifetime. He'd seen the Argentine peso collapse. He'd watched the Turkish lira lose 90% of its value. He'd witnessed the Asian financial crisis of 1997 firsthand. He knew what currency instability looked like, and he knew what came next. "Show me the gold-silver ratio again," he said quietly. The advisor pulled up the chart. Gold was trading at approximately $2,650 per ounce, silver at $71. The ratio, 37.3 to 1. And historically, the client asked. Over the past 100 years, the average is roughly 60 to 1, but if we go back further, to periods of monetary stress, it's compressed to 15 to 1 or even lower. The client leaned back in his chair, processing the numbers. So either gold is overvalued, or silver is dramatically undervalued? The advisor nodded. Or the paper price of silver isn't reflecting physical reality anymore. That conversation, happening in various forms across wealth management offices globally in January 2026, represented a deeper current beneath the surface volatility. Silver wasn't just an industrial commodity experiencing a supply squeeze. It was a monetary metal. And monetary metals behave differently when currency systems show signs of stress. And in early 2026, those signs were multiplying. The U.S. federal debt had crossed $36 trillion. Deficit for fiscal year 2025 exceeded $2.1 trillion. Thus, debt to GDP ratio approached 130%, levels not seen since World War II. The Federal Reserve's balance sheet, despite attempts to reduce it, remained above $7 trillion. M2 money supply. The broad measure of money in circulation had expanded by over 40% since 2020. These weren't secret numbers. They were published openly. Economists debated their implications. Politicians promised solutions. But for individuals and institutions who'd lived through currency crises, the pattern was familiar. Deficit spending accelerates, central banks monetize debt, money supply expands, and eventually the currency's purchasing power erodes. The timing was always uncertain. Sometimes the erosion happened quickly. Sometimes it took years, but the direction was predictable. And when currency debasement accelerated, capital flowed toward hard assets, real estate, commodities, and historically, precious metals. Gold had already reflected this dynamic. From $1,200 per ounce in 2019 to $2,750 in early 2026, gold had more than doubled, but silver, despite identical monetary pressures, had barely moved in percentage terms. This discrepancy attracted attention from institutional allocators. A sovereign wealth fund based in Norway analyzed its portfolio allocation in December 2025. They held $180 billion in assets. Their precious metals allocation was 4%, entirely in gold, zero exposure to silver. Their research team prepared a presentation for the investment committee. The core thesis was straightforward. If monetary metals were entering a structural bull market driven by currency debasement, and if silver's industrial demand created additional upward pressure, and if the paper market was showing signs of delivery stress, then silver represented asymmetric risk-reward. The downside? Perhaps silver stayed range-bound at $70, $75 for several years. The upside? If the gold-silver ratio reverted even partially toward historical norms, if physical premiums persisted, if industrial demand continued accelerating, silver could reach $150, $200, or higher. The fund allocated 0.5% of total assets, $900 million to physical silver. They didn't buy futures contracts. They didn't buy ETFs. They demanded physical delivery, stored in allocated vaults where specific bars were identified and segregated. They weren't alone. A pension fund in Texas made similar calculations. An endowment at a major university repositioned from paper silver exposure to physical holdings. A technology company with significant silver requirements in manufacturing decided to stockpile 6 months of inventory, treating it as strategic reserves rather than just-in-time procurement. The pattern was clear. Informed institutional capital was moving from paper claims to physical possession, but the timeline for broader recognition remained uncertain. Markets could remain inefficient for extended periods. The paper-physical price gap could persist for months or even years before resolving. Leverage in derivatives markets could unwind slowly or catastrophically. 3 scenarios emerged from strategic analysis conducted across multiple institutions. Scenario 1, gradual adjustment. Physical premiums persisted at elevated levels. Vault inventories continued declining gradually. Industrial users adapted by securing long-term supply contracts at higher prices. The paper market slowly repriced upward over 24 months. No major disruption occurred, just persistent structural tightness, probability assigned by most analysts, 40%. Scenario 2, acute delivery crisis. A major institution or group of institutions demanded delivery that exhausted remaining registered vault inventory. COMEX invoked emergency cash settlement provisions. Legal challenges followed. Physical silver prices spiked violently while paper contracts settled at much lower prices. Market structure fundamentally changed. A 2-tier market emerged permanently. Probability, 35%. Scenario 3, monetary regime. Shift, broader currency crisis, accelerated. Multiple fiat currencies experienced rapid devaluation. Capital fled into hard assets globally. Gold and silver both repriced dramatically higher. The gold-silver ratio compressed toward historical norms. Governments intervened in precious metals markets. New monetary arrangements emerged over 3 out of 5 years. Probability, 25%. None of these scenarios guaranteed profits. All carried risks. But all shared one common element. Physical possession mattered more than paper claims. For business leaders, the implications extended beyond investment portfolios. Companies dependent on silver for manufacturing faced strategic supply chain decisions. Securing physical inventory, even at premiums, became a business continuity issue. For entrepreneurs and investors, the situation presented difficult choices about capital allocation during uncertain times. For family offices and wealth preservers, the question became fundamental. In an era of monetary experimentation and expanding debt, what truly constituted a store of value? The retired industrialist in Geneva made his decision that afternoon. He instructed his advisor to convert 15% of his liquid portfolio, approximately $8 million, into physical silver, not futures, not ETFs. Actual metal, stored in his name in a vault he could visit. His advisor asked, "What if the premiums come down? What if physical and paper prices realign and you've overpaid? The old man smiled, the kind of smile that came from surviving multiple financial crises. Young man, I've learned something over 70 years. When markets show you evidence of structural problems, when the price of paper diverges from the price of the real thing, when informed institutions start demanding physical delivery. He paused, looking out the window at the Swiss Alps. You don't wait for confirmation, because by the time everyone understands what's happening, the door has already closed. He signed the authorization form. The next day, his $8 million joined the queue of institutional capital, seeking physical silver in a market where the gap between promise and reality was widening by the week. The vault drainage that began in those 4 days in December was not an ending. It was a beginning, and what would unfold in the months ahead would test whether modern commodity markets could adapt to a world where trust in paper claims was quietly, methodically, disappearing.